Thanks, Shyam. The second quarter of 2023 was exceptionally strong. We're proud to report our third consecutive quarter of GAAP profitability and second consecutive quarter of GAAP operating profitability, generating $28 million of net income and $10 million of operating income. This also marked the third consecutive quarter of expanding adjusted operating margins, highlighting the operating leverage in our business. We surpassed the high end of our guidance for both revenue and adjusted income from operations yet again. We also achieved a significant revenue milestone, surpassing $2 billion in revenue on a trailing 12-month basis for the first time. We remain committed to driving profitable growth, and we reaffirm our expectation of GAAP profitability in each quarter of this year, which would make us eligible for inclusion in the S&P 500 following our Q3 results. Turning to our global top-line results, we generated $533 million in revenue, up 13% year over year and 2% sequentially, exceeding the high end of the range of our prior guidance. Excluding the impact of revenue from strategic commercial contracts, total revenue grew 16% year over year and 5% sequentially. Revenue from our largest customers continues to expand. Trailing 12-month revenue per customer from our top 20 customers increased 15% year over year to $53 million per customer. Customer count grew 38% year over year and 8% sequentially to 421 customers, demonstrating the momentum in our ability to onboard and convert new customers. Now moving to our commercial segment. Second quarter commercial revenue grew 10% year over year and declined 2% sequentially to $232 million, a challenging sequential compare, as anticipated, due to the $14 million decline in revenue from strategic commercial contracts. Excluding the impact from strategic commercial contracts, commercial revenue grew 19% year over year and 5% sequentially. U.S. commercial revenue in the second quarter grew 20% year over year and declined 4% sequentially to $103 million. Excluding revenue from strategic commercial contracts, U.S. commercial revenue grew 37% year over year and 7% sequentially, a result that is even more impressive when compounded with the 24% sequential growth we saw last quarter. Our U.S. commercial customer count grew 35% year over year and 4% sequentially, marking the 10th consecutive quarter of sequential growth. This highlights the velocity we are seeing in our U.S. commercial business, where we're driving significant new customer wins and expansions. Our international commercial business grew 4% year over year to $129 million and remained flat sequentially. Relative to the U.S., we continue to see more muted growth with European commercial enterprises, although there remain targeted opportunities of growth internationally. Revenue from strategic commercial contracts was $19 million compared to $33 million in the prior quarter. We expect third quarter revenue to decline to between $14 to $16 million, and we anticipate fourth quarter revenue from these customers to continue to trend down. For the full year, we expect revenue from these customers to be approximately 3% of total full year revenue. Turning to our government segment. Government revenue grew 15% year over year and 4% sequentially to $302 million. U.S. government revenue grew 10% year over year and declined 2% sequentially to $225 million. While we acknowledge that there are uncertainties associated with the timing of contract expansions and renewals, we maintain a strong pipeline of opportunities and remain confident in the growth of our U.S. government business, particularly as USG TCV bookings grew 111% sequentially. International government revenue grew 31% year over year and 29% sequentially to $76 million. The re-acceleration in our international government business was driven by our UK government work. While our government business generally sees fluctuations due to the nature of funding and contract cycles, we remain confident that our work with the UK government will continue to expand over the long term. Turning to bookings, TCV booked was $642 million, up 62% sequentially. Billings was $603 million, up 52% year over year. We ended the second quarter with $3.4 billion in total remaining deal value and $968 million in remaining performance obligations. As a reminder, RPO is primarily comprised of our commercial business, as it does not take into account contracts with an initial term of less than 12 months and contractual obligations that fall beyond termination for convenience clauses, both of which are common in most of our government business. Turning to margin and expense, adjusted gross margin, which excludes stock-based compensation expense, was 81% for the quarter. Adjusted income for operations, which excludes stock-based compensation expense and related employer payroll taxes, was $135 million, representing an adjusted operating margin of 25%, 200 basis points ahead of the high end of our prior guidance and marking the third consecutive quarter of expanding adjusted operating margins. These results demonstrate our ability to drive revenue growth while efficiently managing costs, with second quarter adjusted expense of $398 million, up only 9% year over year and down sequentially. We continue to manage expense growth primarily by driving leverage in G&A, capitalizing on cloud efficiencies, and calibrating our headcount investments in key strategic areas of growth. Consistent with prior years, we expect to see an increase in expenses in the third quarter as we onboard our new grad cohort of world-class technical talent. As we have stated over the past few quarters, we are fiercely committed to sustained GAAP profitability. On the back of 3 consecutive quarters of GAAP net income and expanding operating margins, we are increasing investments and resources dedicated to our new product, AIP, while at the same time increasing our full-year adjusted income from operations guidance to an excess of $576 million, an increase of $45 million above the midpoint of our prior range. Looking ahead to the second half of the year, we remain focused on calibrating expense growth below revenue growth, even as we increase investment and resourcing to AIP and invest in specific geographies around the world. We generated income from operations of $10 million, our second consecutive quarter of GAAP operating income. We continue to manage our stock-based compensation. As mentioned last quarter, we expect it to trend up through the back half of the year. However, we remain laser-focused on GAAP net income and operating profitability. As we think about equity compensation and aligning it to shareholder value, we are in the process of linking future employee equity compensation to the success of AIP. Turning to net income. GAAP net income was $28 million, our third consecutive quarter of GAAP profitability. Adjusted earnings per share was 5 cents, and GAAP earnings per share was 1 cent. Additionally, our combined revenue growth and adjusted operating margin was 38%. We expect to return to executing in excess of the Rule of 40 for the second half of the year. Turning to our cash flow. We generated $96 million in adjusted free cash flow, representing a margin of 18%, and $90 million in cash from operations, representing a margin of 17%. Through the first half of the year, we generated $285 million in adjusted free cash flow, representing a margin of 27%. We ended the second quarter with $3.1 billion in cash, cash equivalents, and short-term U.S. Treasury bills. We retain access to additional liquidity of up to $500 million through our revolving credit facility, which remains entirely undrawn. Now, turning to our outlook. For Q3 2023, we expect revenue of between $553 and $557 million, adjusted income from operations of between $135 and $139 million, and GAAP net income. For full year 2023, we are raising our revenue guidance to an excess of $2.212 billion. We are raising our adjusted income from operations guidance to an excess of $576 million, and we continue to expect GAAP net income in each quarter. On the back of our third consecutive quarter of GAAP profitability, $285 million in adjusted free cash flow in the first half of the year, and over $3.1 billion on our balance sheet, our board of directors has authorized a stock repurchase program of up to $1 billion. This program reflects our conviction in the trajectory of our business and the value we see in our stock. With that, I'll turn it over to Anna to start the Q&A.